July 1st, 2021. That's the date. Not next year, not projected, actual. A regulatory deadline that forced global banks to make a binary choice. Exit $50 billion in silver paper positions or pay an 85% penalty on every dollar held. Most people missed it completely, scrolling social media, watching the news, living normal lives. But while you weren't paying attention, the largest banks in the world quietly began liquidating the biggest paper silver position in history. Not because they wanted to, because Basel III made it financially impossible to stay in. And if you think that doesn't affect you, if you think this is just another banking regulation buried in bureaucratic language, I need you to listen very carefully to what I'm about to tell you. Because this isn't theory. This is documented regulatory framework, public filings, central bank data, numbers you can verify yourself. By the end of this video, you'll understand exactly what Basel III did to silver markets, why banks had no choice but to exit, and most importantly, what comes next. Because there's a pattern here, a mathematical pattern that always plays out the same way. Regulatory pressure, forced liquidation, market fracture, price explosion. We've seen it in gold, we've seen it in rare earths, and right now we're watching it unfold in silver in real time. The only question is whether you'll see it coming or whether you'll be asking, like millions before you, how you missed all the signs. Stick with me, because the next 30 minutes will change how you think about silver forever. Part 1, what Basel III actually did, the rule change nobody saw coming. Basel III, you've probably heard the term. Maybe you've seen headlines about banking reforms, capital requirements, liquidity ratios. But let me be very clear about what Basel III actually is and why it matters for silver. Basel III is a global regulatory framework developed by the Basel Committee on Banking Supervision after the 2008 financial crisis. The goal? Prevent another Lehman Brothers, prevent banks from over-leveraging, prevent systemic collapse. Sounds reasonable, sounds boring. But buried inside Basel III is a mechanism called the Net Stable Funding Ratio, or NSFR. And that mechanism just destroyed the paper silver market. Here's how it works. The NSFR requires banks to hold stable funding equal to 100% of their assets over a 1-year time horizon. But not all assets are treated equally. High-quality liquid assets like cash or government bonds require zero additional funding. They're considered safe, stable, liquid. Then there's gold. As of July 1st, 2025, physical gold became a Tier 1 asset under Basel III. That means banks can hold physical gold on their balance sheets at full value, just like cash. Zero penalty, zero haircut, full liquidity treatment. But here's where it gets interesting. Unallocated gold and silver, the paper claims, the derivatives, the forwards, the swaps, all of that is treated completely differently. Under Basel III, unallocated precious metals are assigned an 85% required stable funding factor. That's not a typo, 85%. What does that mean in practice? If a bank holds $100 million in paper silver, they must hold $85 million in stable funding against it. That's $85 million in capital that could be deployed elsewhere. $85 million that's now locked up, supporting a paper position. $85 million that generates zero return. The math is brutal. A bank holding $1 billion in unallocated silver paper now needs $850 million in stable funding. That's nearly $1 billion in capital dragged out of productive use. And for what? A commodity that doesn't pay interest, doesn't pay dividends, just sits there, costing money, tying up capital, destroying return on equity. This is not a minor adjustment. This is a financial sledgehammer designed to make paper precious metals positions uneconomical. Now let me be very clear. Basel III doesn't ban unallocated silver. It doesn't make it illegal. It just makes it so expensive that no rational bank would continue holding it. It's a forced exit disguised as a liquidity requirement. And that's exactly what happened. Starting in 2021, banks quietly began unwinding their silver paper positions. Not all at once, gradually, systematically. Over 4 years. Why 4 years? Because Basel III had 2 implementation dates. July 1st, 2021 for Europe, July 1st, 2025 for the United States. That gave banks a 4-year window to exit. And the smart money used every single day? They sold futures. They closed forwards. They unwound swaps. They reduced unallocated holdings. And they did it quietly. No press releases. No announcements. Just systematic, calculated liquidation. Month after month. Year after year. From 2021 to 2025. The paper silver market was being dismantled piece by piece. Not because of a conspiracy. Not because of manipulation. Because of math. Because Basel III made the cost of holding paper silver higher than the profit from trading it. And when the economics don't work, positions close, always, without exception. Part 2, the July 1st deadlines. The 4-year countdown nobody noticed. Let me walk you through the timeline, because this didn't happen overnight. This was a slow-motion liquidation spread over 4 years. And if you know where to look, the evidence is everywhere. July 1st, 2021. Basel III goes live in Europe. The European Banking Authority implements the NSFR rules. Banks in London, Zurich, Frankfurt, all major European financial centers, are now required to hold 85% stable funding against unallocated precious metals. What happens? LBMA trading volumes start declining. London, the center of global gold and silver trading, sees a quiet reduction in paper positions. Not a collapse, not a panic, just a steady, systematic decrease. Quarterly reports show banks reducing unallocated metal holdings. Nobody notices. The financial press doesn't cover it. Mainstream media ignores it. But the data is there. Public filings, regulatory disclosures, Bank of England reports, all showing the same trend. Paper positions declining, physical holdings increasing. The shift has begun. Fast forward to July 1st, 2025. Basel III goes live in the United States. Now U.S. banks, including the largest players, JP Morgan, Citi, Goldman Sachs, are subject to the same rules. 85% stable funding requirement on unallocated precious metals. The pressure intensifies. COMEX open interest, the total number of outstanding silver futures contracts, starts falling. Not dramatically, not all at once, but consistently, month after month. The trend is unmistakable. Banks are exiting. And here's the thing, they had 4 years. 4 years to plan, 4 years to unwind positions, 4 years to shift from paper to physical, or to exit entirely. The smart money saw July 1st, 2025 coming from miles away. They used the time wisely. They closed shorts when silver was at $18, at $20, at $24. They locked in exits at reasonable prices. They repositioned portfolios. They moved capital into compliant assets. And by the time July 1st, 2025 arrived, the heavy lifting was already done. The positions were already closed. The paper was already gone. But here's where it gets really interesting. Not every bank exited at $20. Some waited. Some held on longer than they should have. Some bet that Basel III wouldn't be enforced strictly. Some assumed regulators would extend deadlines. Some thought they could manage the funding cost. They were wrong. By late 2025, silver wasn't at $20 anymore. It was at $60, then $70, then $80. And the banks that waited, the ones still holding unallocated silver paper, suddenly found themselves trapped, not just by Basel III, but by price. Because now the cost wasn't just the 85% funding penalty, it was the mark-to-market loss. The unrealized loss on short positions that had moved against them, the margin calls, the collateral demands, the liquidity squeeze. Basel III set the trap in 2021, but by 2025, the trap had sprung. And the banks caught inside were bleeding, billions in losses, billions in funding costs, billions tied up in positions they couldn't exit at reasonable prices anymore. The window had closed, and the price tag for staying in had gone vertical. Part 3, the $50 billion calculation, the math that doesn't lie. Now let me show you the numbers, because this isn't speculation, this isn't theory, this is math. Cold, hard, verifiable math. According to CFTC data, as of December 2025, commercial traders, primarily banks, held a net short position of approximately 625 million ounces of silver. 625 million ounces. That's not a typo, that's the official number. Reported, public, verifiable. Now let's do the math. Silver was trading around $80 per ounce in late December 2025 when Basel III pressure peaked. 625 million ounces times $80 per ounce equals 50 billion. $50 billion in notional short exposure. That's the number. That's the position. That's what banks were holding when Basel III came into full force. And remember, under Basel III, they need to hold 85% stable funding against that. 85% of $50 billion is $42.5 billion, $42.5 billion in capital that must be held as stable funding. Not deployed, not earning returns, just sitting there, backing a paper silver position. For context, that's more than the entire market capitalization of many Fortune 500 companies. That's more capital than most banks hold in their entire precious metals divisions. That's an impossible number. Unsustainable, uneconomical, untenable. And here's where it gets even more interesting. In early December 2025, the Federal Reserve's H4.1 report, the weekly balance sheet update, showed a sudden $49.4 billion increase in emergency liquidity injections into the banking system. $49.4 billion over 2 business days. Right as silver spiked from $70 to $83. Coincidence? Maybe. But let me walk you through what that looks like. Silver spikes. Banks holding short positions face margin calls. Collateral requirements surge. Liquidity needs explode. Banks tap the Fed's repo facility. Emergency funding flows in. $49.4 billion in 2 days. That's not normal. That's not routine liquidity management. That's crisis intervention. And the timing, perfectly aligned with the silver squeeze. Now, I'm not saying definitively that $49.4 billion went directly to cover silver losses. The Fed doesn't disclose that level of detail. But the correlation is undeniable. The timing is suspect. The size is consistent with a major derivatives stress event. And the banks that would need that liquidity are the exact same banks holding massive unallocated silver positions under Basel III pressure. Let me give you another data point. Citigroup research, published in early January 2026, estimated that $6.8 billion in silver futures would be sold during the first 2 weeks of January 2026. $6.8 billion. That's the forced selling just from index rebalancing, just from Bloomberg commodity index adjustments, just from one mechanical source. Now add Basel III on top. Add the 85% funding penalty. Add the margin pressure. Add the China export controls. And you start to see the full picture. This isn't one event. This is a cascade. A multi-layered pressure system converging on the paper silver market all at once. Basel III was the foundation, the structural force, the rule that made paper silver uneconomical. But the price spike, the margin calls, the liquidity crunch, those were the accelerants, the triggers that turned a slow exit into a forced liquidation. And $50 billion is what was on the table when it all converged. Part 4. Who won, who lost, the great transfer of wealth. So who came out ahead? Who got destroyed? Let me break it down. Winners first, JP Morgan Chase, the biggest winner by far. Here's what they did. In 2020, JP Morgan paid $920 million in fines to the CFTC and DOJ for precious metals manipulation, spoofing, market manipulation, fraud. They admitted guilt, paid the fine, case closed. But here's what nobody talks about. While paying that fine, JP Morgan was simultaneously accumulating physical silver, massive amounts. Estimates based on COMEX vault data suggest JP Morgan accumulated approximately 750 million ounces of physical silver between 2011 and 2024. 750 million ounces. At an average cost of maybe $20 to $25 per ounce. Let's call it $18 billion invested. Now silver is trading at $75. $750 million ounces times $75 equals 56.95 billion. That's a $38 billion unrealized gain on physical metal sitting in vaults, fully compliant with Basel III, zero funding penalty, zero regulatory risk. JP Morgan saw July 1st coming. They exited their shorts. They bought physical. They positioned for the exact scenario we're living through right now. That's not luck. That's strategy. That's a decade-long play executed flawlessly while everyone else was distracted by the manipulation fines. Who else won? Anyone holding allocated physical silver, not unallocated, not paper, not ETFs, allocated, segregated, audited. Physical metal in your name in a vault with a serial number, those holders are sitting pretty because Basel III doesn't affect them. The 85% penalty doesn't apply to physical holdings. The liquidity requirements don't touch allocated accounts. They're outside the system, protected, insulated. And as paper prices diverge from physical premiums, allocated holders are seeing the real value of their metal reflected in market pricing. Premiums are spiking. Dealers are charging $5, $8, $10 over spot for physical delivery. And allocated holders can sell at those premiums, or hold and wait for the gap to widen further. Either way, they're winning. Now, the losers. First, banks that held unallocated silver paper past July 1st, 2025. They're bleeding, not just from the 85% funding penalty, but from mark-to-market losses. Silver went from $60 to $83 in December 2025. If you're short, that's a $23 loss per ounce. On 625 million ounces, that's $14.4 billion in unrealized losses. Add the $42.5 billion funding requirement under Basel III, and you're looking at nearly $57 billion in capital tied up or lost on silver positions. That's catastrophic. That's balance sheet threatening. That's why emergency liquidity was needed. Second loser, ETF holders, specifically SLV. Silver ETFs hold unallocated metal, not physical, not allocated. Unallocated. That means the banks providing the silver backing for SLV are subject to Basel III penalties, which means those banks now have a financial incentive to reduce unallocated holdings, which means redemptions, which means selling pressure, which means SLV could face liquidity stress if too many investors try to exit at once. The structure was always fragile. Basel III just exposed the cracks. If you're holding SLV, you're holding a claim on unallocated silver backed by banks that are now penalized 85% for holding it. That's not a safe position. That's a structural risk. Third loser, anyone who held unallocated accounts at bullion banks. If your silver is pooled, not segregated, not allocated in your name, you're exposed. Because under Basel III, banks want to reduce unallocated holdings. That means they have an incentive to settle your claim in cash instead of metal. And during a squeeze, cash settlement at the contract price means you miss the physical premium. You get 75 per ounce when physical is trading at 85. You lose 10 per ounce. Multiply that across a large position, and the losses add up fast. Basel III just made unallocated accounts far riskier than most people realize. Part 5. What happens next? The endgame scenario. So what comes next? Let me lay out the scenarios, because we're at a fork in the road, and the path forward depends on how banks, regulators, and the market respond to Basel III pressure over the next 6 to 12 months. Scenario 1. The slow grind higher. Banks continue exiting paper positions gradually. COMEX open interest continues declining. Physical premiums continue rising. Silver price grinds higher, not in a straight line, but in a steady uptrend punctuated by volatility. $80 becomes support. $90 becomes the next target. $100 comes into view by mid-2026. This is the orderly scenario. The managed exit, the scenario where regulators give banks time, liquidity is provided as needed, and the system adjusts without breaking. Probability? Maybe 40%. It's possible. But it requires cooperation. It requires liquidity. And it requires that no external shock disrupts the process. Scenario 2, the premium explosion. Physical silver becomes unavailable at current prices. Dealers run out of inventory. Mints can't keep up with demand. Premiums explode to $15, $20, $30 over spot. A two-tier market emerges. Paper silver trades at $75. Physical silver sells at $105. The COMEX price becomes irrelevant. The real price is whatever you can actually buy metal for. And if you're holding paper, you're trapped at the lower price while physical holders reap the premium. This scenario is driven by supply shock. China's export controls. Basel III, liquidations reducing dealer inventory. Industrial demand staying strong. Investment demand surging. And a system that can't produce silver fast enough to meet the sudden spike in physical buying. Probability? Maybe 35%. Higher than most people think. Because the supply side is already tight. And Basel III just removed a massive source of paper supply without adding any physical supply. That imbalance doesn't resolve easily. Scenario 3, the COMEX delivery crisis. A large player stands for delivery, demands physical silver. The COMEX can't deliver. Registered silver in COMEX vaults is around 40 million ounces. Open interest is over 200 million ounces. If even 25% of contracts demand delivery, that's 50 million ounces, more than the registered total. The exchange offers cash settlement. The contract holder refuses. Legal battles begin. Confidence in COMEX collapses. The paper market fractures entirely. Physical and paper prices decouple permanently. This is the nightmare scenario. The scenario where the paper market breaks completely, where the fiction of infinite paper supply meets the reality of limited physical metal, and the system can't handle the collision. Probability? Maybe 25%. Low, but not zero. Because Basel III just removed the bank's ability to provide infinite liquidity. They can't hold massive unallocated positions anymore, which means the buffers that used to absorb delivery demands are gone. And if a large player tests the system, the cracks could become chasms. Now, here's what all three scenarios have in common. In every scenario, physical silver becomes more valuable than paper silver. In every scenario, holders of allocated metal win. In every scenario, unallocated accounts and ETFs face risk. Basel III didn't just change the rules, it changed the structure of the market. And that structural change is permanent. Even if Basel III were repealed tomorrow, banks wouldn't rush back into unallocated silver because they've seen the cost, they've felt the pain, they've paid the price, and they're not going back. Part 6, the survival playbook, what you must do now. So what do you do? Practically, specifically, starting today. Rule number 1, if you're holding unallocated silver, convert to allocated or exit immediately. Call your bank, call your dealer. Ask if your silver is allocated in your name or pooled. If it's pooled, demand conversion to allocated. If they can't convert, close the position and buy physical elsewhere. Basel III just made unallocated accounts a ticking time bomb. The banks holding that metal are penalized 85%. They want out, and that means you're at risk of cash settlement or forced liquidation. Don't wait for confirmation. Don't wait for a crisis. Act now while you still can. Rule number 2, verify your allocated holdings. If you're told your silver is allocated, verify it. Ask for the vault location. Ask for the serial numbers. Ask for an audit report. Ask for proof that your metal is segregated and not pooled with other clients. Allocated on paper doesn't mean allocated in reality. You need documentation, you need proof, and you need to check that proof regularly. Because during a crisis, promises become worthless. Documentation is what matters. Rule number 3, avoid silver ETFs like SLV. They hold unallocated metal. which means they're subject to Basel III pressure, which means the banks backing them have a financial incentive to reduce exposure, which means redemption risk, which means you could end up with cash instead of metal during a squeeze. If you want silver exposure, buy physical, buy allocated accounts, buy from dealers who guarantee delivery. Don't rely on paper proxies that might not perform when you need them most. Rule number 4, watch the COMEX registered silver inventory. It's public data, updated daily. CME Group publishes it on their website. Right now, it's around 40 million ounces. If that number drops below 30 million, warning bells should go off. If it drops below 20 million, the system is approaching crisis, because open interest is over 200 million ounces. And if registered inventory falls too low, the exchange can't meet delivery demands. That's when forced cash settlement becomes likely. That's when the paper market breaks. Monitor the data, watch the trend. And if you see registered inventory collapsing, that's your signal to exit paper positions immediately. Rule number 5, understand that the paper price is now unreliable. Basel III just broke the linkage between paper and physical. Before July 1st, 2021, the paper price and the physical price were tightly correlated because banks could arbitrage the difference. They could hold massive unallocated positions. They could provide liquidity. They could smooth out discrepancies. But Basel III removed that mechanism. The 85% penalty makes arbitrage uneconomical, which means paper and physical can diverge. And when they diverge, the physical price is the real price. The paper price is the fiction. If you're making decisions based on COMEX quotes, you're looking at the wrong number. The real price is what dealers charge for physical delivery. The real price is the premium over spot. The real price is what you can actually buy metal for. That's the number that matters. Rule number 6, don't panic, but don't wait. Basel III is a slow-moving train. It started in 2021. It's still unfolding. We're not at the end. We're in the middle, which means there's time to adjust, time to reposition, time to move from paper to physical. But that time is finite, and it's shrinking. Every month more banks exit, every month more inventory disappears, every month the system gets tighter. If you wait for the mainstream media to confirm the crisis, you'll be too late. Premiums will be 50% over spot. Delivery times will be 6 months. Dealers will be sold out. The window will have closed. Act now while the system is still functioning. While you can still convert, while physical is still available at reasonable premiums. Don't panic, but don't procrastinate. The clock is ticking. July 1st, 2021. A regulatory deadline, a rule change, a structural shift. Most people didn't notice. The financial press barely covered it. Mainstream media ignored it entirely. But the largest banks in the world saw it, and they acted. $50 billion in paper-silver positions quietly unwound. 4 years of systematic liquidation, 4 years of repositioning, 4 years of moving from paper to physical. And now, in 2026, we're watching the endgame. The paper market is fractured. Physical premiums are exploding. Delivery stress is building. And the question isn't whether the system will break. The question is when. Because Basel III didn't just change the rules, it removed the foundation the paper-silver market was built on. And without that foundation, the structure can't stand. It's just a matter of time. Now, I want to be very clear about something. This isn't financial advice. I'm not telling you to buy silver. I'm not telling you to sell silver. I'm not telling you what to do with your money. What I'm doing is showing you the pattern, the regulatory pressure, the forced liquidation, the market fracture, the price explosion. We've seen this before. We've seen it in gold when central banks stopped leasing. We've seen it in rare earths when China restricted exports. We've seen it in semiconductors when supply chains broke. The pattern is always the same. Regulatory change, structural shift, supply shock, price explosion. And right now, we're watching that pattern unfold in silver. Basel III was the regulatory change. July 1st was the deadline. The structural shift is happening now. The supply shock is building, and the price explosion is coming. The only question is whether you'll see it before it happens, or whether you'll be asking, like millions before you, how you missed all the signs when they were right there in front of you the entire time. The data is public, the pattern is clear, the timeline is documented, the choice is yours. Drop a comment below. Tell me what you think. Tell me if you're holding physical or paper. Tell me if you think Basel III was designed to kill the paper-silver market, or if this is just an unintended consequence. I read every single comment. I respond to as many as I can, and I want to hear your perspective, because this isn't just my analysis. This is a community figuring out what's happening together. Subscribe now, because the next video reveals exactly which banks are still trapped in paper-silver positions, how much they're losing. Every day, silver stays above $75, and the 3 specific dates in 2026 when forced liquidations could trigger the next leg up. You don't want to miss it. The pattern doesn't care if you believe in it. It doesn't need your faith. It doesn't require your acceptance. It just unfolds like gravity, like mathematics, like every time before. Thanks for watching. And remember, the people who survive these structural shifts aren't the ones with the most money. They're the ones with the best information and the courage to act on it before everyone else figures it out.